And we're live. Iman, why do you look so smart?
I had a client meeting today, and I thought we're having a nice special guest on our podcast as well, so I'll make an effort. I'm wearing shorts though.
Did you charge them 6 figures for some slide decks?
What is consulting if it isn't that, mate?
Cool. I think we had some really good feedback on the previous episode, which we did together on go-to-market for founders from a strategist point of view, and how to set up effective product management function within a company from my point of view and experience and what I've seen work. And now, as I said, as we promised, we've got you guys know the way our brand works. We're very selective with the guests we bring on, and strictly world-class VCs, investors, founders, execs, and the guests.
Sorry for laughing.
And the guest we have on is laughing, but no, genuinely, I think, and we had to do this. So yeah, absolute pleasure to introduce you to Andi Kazeroonian of Outward VC. Andy, what's up?
Hi there, guys. Yeah, good. Thanks for having me. Been looking forward to this all week.
You told me it's your first pod, and we told you, don't sweat it, it's all good.
Yeah.
Wait until we ask the really, really brutal questions, and then think about that again.
just simply like, that's when I'm going to call for a cut. We're gonna have to. I hope you boys are good at editing, because might have to be a fair bit.
Cool. So I think before we even dive into anything to do with Outward, sort of FinTech, what you're working on, deal structure, anything and everything, best place to really start is a good background in yourself and how and why you ended up where you are, in a day and age where people are killing themselves to become VCs, especially MBAs who send probably 400 cold outreach emails to become a VC. And you told me something really interesting when we were having a breakfast a while ago, pre-COVID, about VCs. You said, everyone tries to make it out super glamorous, but sometimes you don't know the results of how good you are until 7 or 10 years in. And so, give us a good background of how did you even end up here?
Yeah, well, it depends how deep you want to go, but
going deep.
So studied. I'll start from university. If you want me to go deeper than that, happy to. But did economics and finance at university. Kind of left actually wanting to be a trader. Was obsessed with like FX and stocks, and kind of wanted to get. And I loved the buzz of the trading floor, so desperately wanted to get involved. I ended up, I graduated in 2013. And it was a pretty tough time. I think any year is tough now, given how competitive it is, but it was pretty tough. I ended up taking an internship at a small mid-cap investment bank doing corporate finance, which I didn't actually know what corporate finance was at all. But I just kind of thought it was a way to somehow get on the trading floor. The more I did it, in terms of advising companies on, mergers and acquisitions, IPOs, etc., the more I realized actually there's quite a lot of skill set you can kind of take from something like this and then go off and do many other things where it's entrepreneurial ventures or move on to the investment side, etc. Anyway, fast forward a year, I went from there to Investec, which at the time still, the leading mid-cap investment bank, so deep advising a lot of businesses in the consumer, retail, leisure and gaming space. I kind of did that for a few years and then kind of came to a point in the road where you're just like, okay, what does the next project look like? The next 3-4 years, am I kind of going to try and climb the ranks in corporate finance, or do I want to go off and do something else? And to be honest, it was serendipity more than anything that someone who I was kind of very friendly with at Investec was starting, there were talks beginning around starting some kind of a venture capital business, without knowing really what that looked like yet. It was just kind of good timing. It ticked the boxes for me in terms of, working with much earlier stage companies where there's a much more of a kind of personal connection. It's not just kind of looking at numbers and data. the best way I put it to other people when I describe it is when you're asking questions or you're challenging a business with early stage, you are challenging the founder directly, so you need to be careful about how you kind of phrase things sometimes. So working with earlier stage businesses, another thing that I found was when you're doing advisory, it's a very kind of transactional type relationship. There's some sort of an ongoing relationship as well, but the difference is the big buzz is when the deal happens and then you kind of move on to an extent. Whereas on the investment side, you do the deal and that's really just the start of, as you said, like a 10 plus year relationship. So we kind of made that leap. So I was kind of one of the founding team members of Outward. We started that business literally with a blank sheet of paper with the intention to kind of spin it out into a kind of standalone independent business from Investec, where it would be more of a kind of LP GP relationship with Investec, albeit keeping very close ties and a close partnership with the organization. And I can go into a little bit later about how that kind of benefits our portfolio companies. But we introduced another number of other kind of corporate, family office, private investors that span from banks to technology entrepreneurs to financial services veterans. And here we are. Kind of Outward VC was formally launched in the summer of 2019. And we've been kind of at it since then, really.
I guess a lot of stuff there that the people that I guess listen to this podcast will relate to, which is really interesting. And I think the majority of people that listen to this podcast understand VC and the sort of market that VC sits in, and the sort of surrounding landscape of it. I guess the question that pops out immediately is who are Outward and how do they sit in that sort of environment, and kind of what does the firm therefore focus on as a result of where it sits?
Sure. Yeah, it's a good question. So it probably helps to set the context of kind of what sectors we invest in at the stage. So given all of our backgrounds are within financial services, our cornerstone LPs, our banks, a number of our private investors are from the financial services industry. Our kind of intent was always to invest in an area with focus where we could bring, I'm sure every VC says this, but more than capital to the table and kind of deep industry expertise, relationships, network, infrastructure, whereby we can actually accelerate the growth of the businesses we invest in. So that's kind of why we broadly, and I'll kind of go into detail of how we view FinTech because it's not as narrow as it sounds. But on top of that, when we looked at the market, and this is way before we launched the fund, but was kind of subject to our investment experience, it's very crowded, it's getting very, very competitive. But what we saw was that a lot of the kind of late seed stage funds or seed stage funds were kind of raising larger and larger funds, and they were moving up the chain to kind of Series A, B, beyond that. There's always been a pretty well-established kind of investment ecosystem at the seed level, but because of initiatives like EIS, SEIS, VCT funds, there's a lot of capital, kind of early stage funding. But we felt that at that late seed stage where you're kind of not quite Series A metrics, but you've got a product, you're generating some revenue, you've got a core team in place. There are a number of investors there, but there wasn't any kind of FinTech focused late seed funds where you could actually come in, take a little bit more risk, but know that you can, with your network, with your infrastructure, better assess the kind of chances of that business becoming successful, but more importantly, actually giving the business fuel to kind of accelerate its growth going forward. So that's kind of why we chose late seed and FinTech. But we look at FinTech quite broadly. So it's your classic kind of financial services verticals like payments, lending, capital markets, neo banking software, consumer banking, etc. But it's also, we call it adjacent enterprise software. So any software that is either selling into banks, financial services to help kind of power the way they do things, or what you're seeing this trend of kind of like embedded finance. So any kind of digital player which in time can start embedding financial services into their platform. So for example, we've got things like employee health and well-being platforms in there. We've got data privacy, we've got legal DD automation, as well as the kind of classic fintech businesses.
Aside from fintech, what are you most bullish on sector-wise?
Aside from fintech, I look at, so I'm going to kind of have an outward hat and my personal hat as well. So I'm a big fan of, well, I think my view has always been, even way before I got into tech, that the way our education system works is just completely broken. Everything from the discovery of education to the financial services, the lending behind it, to the actual delivery of it, and then closing that feedback loop to the kind of opportunities and then continuous learning. So I'm generally bullish on anything that massively kind of disrupts and improves the way that education is kind of, again, either discovered, financed, delivered, kind of job opportunities after that, and closing that feedback loop. Massively bullish on that. I'm generally bullish on modern kind of next generation infrastructure as a whole. So we kind of focus on a lot of that within fintech. We've also invested in the insurtech space with these kind of like infrastructure platform plays, where they are looking to kind of, if you look at the kind of tech stack of a bank or an insurer, I mean, it's, for the most part, it's a complete mess. It's old, it's antiquated. None of it really communicates with one another. And often you can put in patches to kind of build APIs and all that stuff, but eventually they are going to have to re-platform. And I think, but what you typically see is these infrastructure players begin servicing the kind of new digital players in the market. And then in time, they will start kind of moving up the chain of servicing the smaller incumbents, and then eventually the kind of larger players. So in fintech, things, for example, you're seeing things like Thought Machine in the market that are providing this kind of modern banking infrastructure. I'm personally invested in a business called Griffin, which is kind of banking as a service platform. There is, we're investors in Bud, which is an open banking platform, Aventus in insurance. So we're big fans of this kind of like infrastructure as a service, platform as a service play. And it's, whilst we're focused on insurance and financial services, you're seeing it in legal, in recruitment. Every kind of sector has its own new next generation operating system that it runs on. So I think that's hugely exciting.
Am I correct in saying you guys got an early stake in Primary Bid?
We did. We got an early stake in Primary Bid. Obviously, that's been one of the kind of very much star performers of the portfolio. I think that was one, given my kind of background in investment banking, that was one that I saw when we met them, and it seemed very obvious to me at the time. The problem was very apparent. I think everyone who has invested in a stock has probably experienced it and understand it. And I think if you're on the deal making side, so for the context of the listeners, actually, to people who don't know what Primary Bid does, they enable retail investors to participate in the primary share issuances of listed businesses. So for a retail investor, typically you're not really able to participate in the discounted primary share offerings or IPOs. You're having to buy it on the secondary market at full price. So what they have done is created the infrastructure in order to connect listed companies, investment banks, retail investors, and intermediaries in order to make all that happen. And it was one where, so I have this view that really great businesses, when you meet them, they should be, there should be an element where you kind of leave that meeting with a bit of doubt, because it's so hard to actually do. And I left that kind of first meeting understanding the problem, loving what they were doing. But really great businesses become great businesses because what they're doing is very hard to execute. And having been on the deal making side, I couldn't even kind of conceptualize the idea of bringing retail investors into these deals because of how difficult the infrastructure is, how kind of onerous the regulation is for banks to have to introduce retail investors. So, they have, so as I said, we invested in their kind of the first main institutional round. They probably did about 3-4 years of growth in the space of 6 months. And listen, it was kind of at a time as well, given COVID, where every listed company under the sun was having to raise capital. to kind of support their future, and which amplified the problem. So retail investors getting shut out before was a problem, but when their dividends are getting slashed and these businesses are all raising at very significant discounts, all of a sudden it becomes very evident that there's just a huge disparity with how the market works.
Can I take a step back on that for 1 second, Andy? Just to clarify, when you talk about primary bid, I guess the value proposition of the business is that it enables, as you say, retail investors to get involved with share issuances. But is that on the sort of post-IPO mature business seasoned share issuance, or is it at the IPO stage where you've got new forms of ways of entering the market, like SPACs, that could also be competition?
So the answer is they can do both. They've done IPOs, they've done follow-on. The reason why I mentioned follow-on is twofold. It's one, if you look at the amount of capital that's raised in the public markets, the vast majority is follow-on capital. If you look at the number of IPOs, there aren't that many that happen in any given year, compared to follow-ons where companies regularly raise capital, and it's why they kind of list, so they can tap the market. But secondly, if a company wants to have retail investors in their IPO, there is a mechanism to do it, but it's a very messy one. You're having to go through a number of different intermediaries. But with follow-ons, because with an IPO, the deal can take place over a much longer period of time. So if you want to do a retail offering, in the absence of, this was pre-primary bid, you could have gone through retail stockbrokers, you could have put an issuance out there, but then, the broker needs like a long period of time to get orders in, you need to aggregate all of that, it's very messy. With follow-ons, banks do institutional only offerings because they can happen literally in the space of 3-4 hours. With pre-primary bid infrastructure, there's just no way you can assemble retail investors, give them the information they need, aggregate all of their orders, and manage that in the space of 3-4 hours. So that's the kind of magic to what they've been able to bring. They've been able to basically treat retail investors as one institution and bring them alongside highly qualified blue chip institutional investors and investing pari passu on the same terms with them.
Yeah, so the reason I mentioned primary bid is because recently they raised 50 million funding round, most recent round, which included a 9% stake from the London Stock Exchange Group. And your portfolio is, again, which is the reason I said I want to bring you on, your portfolio being super impressive. You've got the likes of, as you said, Bud, Curve, Moniz, Primary Bid, and a bunch of others as well. I guess what I want to ask is, building any startup is the most difficult thing, let alone building a fintech in a market as regulated as the UK and as old school and with all the dinosaur infrastructure that you have in place with the high street banks, regulation, etc. So I actually published an article on not really just fintech, but my view of the markets, which Iman's laughing here, but I
would highly recommend you read
Why was it highly controversial?
Kind of all guns blazing, but
okay.
it's on rationalvc.com. Basically the article is on the irrationality we're seeing in the tech markets and what to avoid. And I suppose I didn't really include fintech in the article. I discussed a lot of what we're seeing among B2C, non-fintech related, including D2C brands, some SaaS brands, etc. But nothing on fintech, specifically because coming from a finance background myself, I know how difficult it is. The only one, which is really, we've heard of it breaking even recently, was Starling, with Anne Boden doing a terrific job. But how do you guys assess these at an early stage and the 5 to 10 year view? Because there's this analogy in VC of, it's a dartboard. You're throwing, let's say, 20 darts at the board and maybe 2 of them will stick and they make up, the gains are so exponential that it makes up for the losses on the other 18. But what's your view on the current state of the market, these valuations we're seeing, how long it's taken, the challenges that fintechs are facing? I suppose it's probably a few questions in one, and also how you guys really just assess that in your decision making, because we like to discuss decision making and mental models a lot, especially around investing. So how you apply yourself in those scenarios?
I'll try and decouple a few. Let me know if I've forgotten anything. But No, listen, you raise a good point about the profitability of even mature fintechs. And I think that's certainly something you've seen change throughout the course of COVID. Even I do think you're seeing, and this is anecdotally speaking, but speaking to investors in our own thinking. I mean, to be candid in terms of outward, I don't think we were ever a kind of growth at all cost type investor. I think we're all investors that we want to see, we want to see fast growth. We want to see businesses with international ambitions and take market share quickly. That being said, we've always looked at businesses as we want businesses that have kind of robust business models that you can at least see a clear path to how this business stands on its own 2 feet, and not just relying on building user numbers and client numbers and get taken out by a large player, because in reality that doesn't happen very often. So focus on things like unit economics, business model, go-to-market strategies very, very early. Now, conscious that at early stage, you're not going to see that much meat on the bones, but it's about the founders and the founding team's ability to articulate how you're going to get from A to B to C, and knowing that eventually that business will be able to stand on its own 2 legs, on its own 2 feet. But, in the wider market, you are seeing more and more of a focus, and this is even the businesses coming to us, more and more of a focus of businesses wanting to show that proactively, that they are not just growing at all costs. They've got a profitable business model, one that has profitable unit economics from like day zero, one that can become profitable at a group level very quickly, one that is able to kind of acquire users at a very low cost through kind of innovative acquisition channels. So before, you saw it as kind of an added bonus of, this business is kind of looking at things a bit, slightly more responsibly than normal. But now you're seeing it as a kind of like prerequisite. Every single business you come across now has kind of, I guess, learned a few lessons over the last year, and coming at you with something a little bit more robust. That being said, I think when you discuss neobanking, it's hindsight's 2020 with a lot of investors that invest in neobanking. And I think the reason, and I'm not going to name any players here either, because it's not my place to, but I think the general thesis for a lot of the kind of neobanks were, we want to kind of completely transform the business model of banking. So we don't want to have to rely on lending or any of these kind of capital intensive banking service. We want to create a kind of the Apple of banking. We want a super slick product, and we want it to, we want a super slick product, and we also want a different business model, whether that's a marketplace or otherwise, or create kind of a revenue from non-financial means. I think what Starling have done, and the reason why they have now, and again, I take all these figures with a huge pinch of salt, not to throw any shade of Starling, but before you see a kind of full, P&L and financials and all that stuff, you don't know exactly what profitability means and what adjustments are being made.
Sorry to interrupt you there, just before you carry on. I literally mentioned this in the article as well, that as Charlie Munger says, EBITDA equals bullshit earnings.
I agree. And I'm not to say, this isn't saying they're not profitable. They probably are, but I just don't know what that looks like yet, so I won't comment on it. That being said, what Starling, from my understanding of the business, is they have still gone for kind of traditional banking business models, but they've gone for more of a kind of, we are a bank, but our back office is utilizing from scratch technology infrastructure. So it's a much lower cost of operating what is a full scale bank. So who knows who will kind of win? And I think that similar to retail banks, and this is why I never got caught up in the kind of who's going to win. Look at the UK. We have 4 or 5 huge high street retail banks. Every other country has 3, 4, 5 huge retail banks. The only difference with these is that they can actually go cross markets very, very easily, whether the traditional retail banks can't as easily. So I don't see why all of them can't win. They're all going international. They've all got huge user numbers, and they're all going to have innovative ideas for how they generate revenue and ultimately become profitable. So I don't get to. So sorry, to go back to your question. So it was about profitability was one. The other was how we I think I answered one, but I can't remember whether it was profitability. I think I answered two of them, but I can't remember which one was the other. But to go to in terms of how we assess, don't want to just call this fintech businesses, kind of what we look at when we look at businesses. It's ultimately, it's a number of things, but the way we look at it internally is we have kind of a few questions, big picture questions that we want to answer, and you want to kind of have a conceptual answer of it after the first meeting and a very robust answer to it towards the end of your process. And that's ultimately comes down to, why do you think this team will succeed? And I can go into detail in a lot of these, but why do you think this team will succeed? Why is this an attractive market to be going into? Why does this product need to exist? How or why will this become a category leading business? And finally, why does Outward have to invest in this business? And those 5 questions seem very simple, but when you are kind of pitching it internally to a very kind of, we don't take these things lightly, and the default thing is to, hammer you down and challenge assumptions and make sure everyone's got very high conviction to do the deal. You need to come with some pretty serious ammunition and some pretty high conviction. So, for example, with the team thing, it's, why are you convinced that they can raise capital every 12 to 18 months? Why do you think they'll be able to attract really, really talented people? Are you confident that they'll be able to hurdle through significant challenges that inevitably will come their way? Can they scrap? Can they hustle? What's the team they've already built around them? Are they complementary? Do they have good chemistry? And that's just the team part. So we really we call it the 5 questions. So we answer those 5 questions conceptually after the first meeting. And then by the end, you need to have like a very, very, very robust answer to those 5 questions. And if you can, then chances are you've probably got a pretty good deal that should be done.
That's super interesting. So I wrote a piece on go-to-market strategy for founders and some of the initial things you need to think about when you're taking a product or a solution, if you will, to market. And it's so interesting to hear it from the investor side as to some of the questions you want to answer, because they fit quite neatly into the structure that I outlined, but also that large scale accelerators like YC outline. So it doesn't seem like anything is actually left to chance. Like, all the information is available to people if they want to go and build something. But something I want to challenge you on is, on the team front, you've got like really successful founders, right? And it's really hard conceptually, and you use the word conceptually, I think aptly, but you can't. How do you know if a founder's really good? Like, how do you know if a founder's going to kill it? And then what compels you to make that bet on the founder specifically within the team?
It's a good question. I think the easy answer to that is you never know. You never know. You're always taking a bet is the wrong word, but you're taking a view that the founder has the founders have the capability to do so. How do we form that view? Ultimately, it's looking so there's a few, one of the things I look for, and this is put together kind of the obvious things, like what have they done in the past? What experience do they have? What have they built to date? But it's one of the things I look for, the trait I find common in the most successful founders that I've come across is their ability to like very clearly articulate very complex or simple concepts to multiple different audiences.
You're reading from my article script here.
Right. Okay. So you've nailed it already.
You're articulating it a lot better than I did.
Yeah. So that's the thing. People who are able to deconstruct very, very complex concepts and articulate it to various different audiences in different ways that resonate with that audience. So with investors, with clients, with talent, and ultimately what that comes down to is kind of, can they sell, right? Because it's either you're selling product, you're either selling the business with regards to attracting people, or you're selling the vision, the equity story to your investors. So it's your ability to kind of there's a reason why they call it an equity story, right? It's because people want to see what the future looks like and some notion of how you're going to get there. So people, and that's why you see stories of people raising like such huge sums of money just off a pitch deck, because they have the ability. Not to say that we necessarily get involved in those sorts of deals. That being said, is because they can paint a very, very, very clear story of exactly how they're going to get there and why they're going to be a category leading business. But other traits we look for is ultimately like, it's little intangibles. Have they got some battle wounds to kind of show going into it? You know, have they made mistakes in the past? Have they learned from it? How have they evidenced that? Like, have they shown evidence that they've been punching above their weight? So, for example, you might have like a young founder with no experience, but somehow has managed to get angel investment from super experienced people within the industry, got a cracking advisory board, attracted people to work for them that are way smarter than them, way more experienced than them. It's these kind of early signs that you can extrapolate and say like, okay, there's enough here that you can look forward and see like they can attract talent, they can secure capital, and they can sell product. And they have a very clear vision of where they want to go. And also there's the intangibles, right? It's like, you know, have they got this resilience about, even for the way they answer questions when they're challenged, you know, can they take criticism? Can they listen? But at the same time, have they got like slightly unwavering conviction in what they're doing? You know, there's so many different ways of like unpacking how you assess a team, and ultimately it's some teams you may assess on some strengths and some teams you may assess on others. You rarely see people that have the absolute full package, but it's really about what can I help with and what am I less able to help a founder with.
Andy, would you say there is a slight issue in UK versus US when investors are betting on founders? And what I mean by that is UK tradition, it's very old school, the whole model, in my view anyway. It's if you're Oxbridge or Imperial, PhD in a STEM, and if you've done 2 years at McKinsey, that's the cherry on the cake. Whereas in the US, the whole landscape seems to be a lot more meritocratic. And if a founder has, let's say, as you said, battle wounds, you've had 2-3 failures. I mean, Jason Calacanis says this in the US, the fourth time around, it's kind of batting average. You're kind of bound to get it right by the fourth or fifth time. Yeah. Of course, if the first time you bet on them, you had the belief and you know that they're the type of person, they got the hustle, as you said. So I think the UK, in my view, and I'd like to get your thoughts on this, is very old school and backward still. It's like when Sam Altman from YC came to London to have a meeting in the Ritz and he got kicked out for wearing sneakers and a hoodie. And, you know, you see the number of unicorns that have come, not just the UK, number of unicorns that have come out of Europe versus US. And every sort of, you know, the most experienced execs in the Valley say, look, the future is literally just Silicon Valley and China. And Europe is pretty much done in the next 10, 20 years. But you're on the inside, you're seeing all the talent come up. What's your view on this whole thing? And what can the UK do to nurture more talent and be less old school and break down these barriers for founders?
Yeah, listen, it's a really good point. I think it's a valid one. I think historically it was worse. I do think it's getting better. So I don't have the data in front of me, but I remember a year or two ago, just out of personal interest, I share your view. I think it's definitely, and when I say diversity, I mean in all forms, in terms of educational background, ethnicity, gender, everything. Diversity of thought. So I think it was a year or two ago, I did some analysis on the kind of the top 20 most funded companies in the UK and looking at their educational backgrounds. And it was, I may be speaking off that, I think it was something like 9 out of the top 10 were either Oxford, Cambridge, with the Oxbridge, INSEAD MBA, or like, it was 2 or 3 very, very elite institutions. And then it was something like 15 out of the top 20 or 16 out of the top 20. But then a part of me, I think to unpack that, there's some complexities as to like why that is. It's not just, I don't think it's, and I know from the inside, it's not you seeing a founder that comes from Oxbridge and they're like, oh, great, yeah, tick box, they go through to the next stage. I think it's it's also a function of some of these institutions having very strong and deep networks, which is often where the capital comes from as well. So it's you have to look at every area of the chain. It's the networks they build. It's the kind of infrastructure that so for a lot of these universities have their own seed funds. They have they foster entrepreneurialism for students. So whether it's the MBA programs or the elite universities, whereas I think, I guess that's my way of answering is I think that exists. I think it still exists. It's getting better. And what's making it better, I think, first of all, awareness of the problem. I think most people, again, I don't want to speak on everyone, but I think a lot of people out there, if they have these biases, they are genuinely unconscious biases. I think they are not, a lot of them aren't actively excluding people because they haven't gone to Oxbridge. It's just something in the back of their head, where they warm towards a certain person or a certain business because that's the background they come from. So I think awareness of the problem is a good thing, because people can sit there and reflect and say, actually, yeah, we can look at our portfolio and it's not good enough. It's not diverse enough. We need to be doing more. I think there is a lot going on in the industry in terms of whether it's just initiatives such as open office hours, where it's giving founders who don't come from these archetypal backgrounds, whether that's gender or ethnicity or, again, educational background, there's more capital going into this space in terms of actual dedicated funds for investing in kind of underserved founder groups. There needs to be more. I think one of the problems and one of the disconnects here is that, and actually I'm going to give a shout out to Mountside Ventures. They did a good report on this recently with Allocate. The kind of appetite and noise you're hearing about amongst VCs, that they are doing a lot to try and improve diversity within their portfolios, within their teams, but that doesn't hold true with where the capital's coming from. So I think a lot of institutional LPs, I don't think it's quite there. I think they're trying, and I think there is more happening there, but I don't think it's quite got to the point yet where VCs are in terms of their kind of quest for being a bit more inclusive with their capital. And until it happens at every layer, it becomes very challenging for it really to be equitable for all.
Let me challenge you on that then. So you've spoken about the sort of investment industry, VC side of how VC needs to shift, and what are the sort of things we need to think about from becoming more diverse as an industry. Yeah. But if you're a founder coming in today and you didn't go to a good uni, or scrap that, you didn't go to uni, but you're coming up with a cool, you think you've got a cool idea and you've put together a nice pitch pack or something, what advice would you have for those guys, particularly if they're from non-represented backgrounds? To kind of, what advice would you have for them to build and to kind of raise capital subsequently?
So you've already mentioned one of the points, and that is, build. Learn how to build. The more you can build, the more you kind of can scrap together. And this is my advice generally for any kind of very, very early stage company founder looking to raise any form of capital at all. Not kind of our stage where for context, we're writing checks of £1 million in round sizes of 1.5 to 5. Even if you're raising your first 50 to 100 grand, you've got a much better chance of doing that if you can show something. If you can build something, any sort of minimal kind of minimum viable product to show, this is kind of what I've scrapped together. This is the genesis of it, but this is what we want it to look like. This is what we've been able to achieve with the little amount of capital we have. It doesn't matter what kind of background you come from. All investors love people who build, and people who come to them with something, and people who can demonstrate that they can be very capital efficient with very, very little. So the advice I would give was, it doesn't cost a lot at all to build something very, very primitive. You can do that with very, very little money. And there are a lot of kind of, whether it's schemes or organizations offering grants or just angel investors that, get SEIS tax breaks and EIS, where the exposure is so little that they're happy to kind of take the leap. But you've got a much better chance. And unfortunately, this probably does come down to the diversity point. It's if you've got if you go to an elite institution, or it probably means you have built up a kind of elite network along the way, which means you'll have to take a step back. Most angel capital comes from very, very trusted parties. So it comes from people that already have money. So ultimately, it doesn't matter what background you come from. You need to try and find a way to build a network of relevant people that can help you. And long before you ever meet a kind of institutional investor. So that's either people that know how to build, that believe in your mission. That's people that are, from the industry, who are happy to help kind of young budding entrepreneurs and help them win their product. And you'd be surprised at how many founders I've come across that have, just by cold outreaching people on LinkedIn, like people within the industry. So it may be like a C-suite of a company, or some, whether it's they need marketing expertise or product building expertise. People generally are happy to help when like you reach out to them in earnest and you've got something exciting that you want to build. But you need to be very, very persistent. But that, going back to that's a long way of saying build. Like build something. If you come with a pitch deck, you better have a really, really solid network behind you, because they are literally just going by you. If you can come with a product, yeah, they're still investing in you, but you're showing that you're not coming to them empty-handed. And then it kind of escalates from there. And then along the way, it's about leveraging the network. So it's about, if you manage to get those first 3, 4, 5 people that help you, it's leveraging their networks, then leveraging their networks. And I've seen many people grow absolutely phenomenal networks from really, really engaging their early stakeholders, not just their investors, but anyone who is willing to help.
I love the point on LinkedIn outreach, because I'm probably the most annoying person in the world online. I've exhausted LinkedIn and email outreach, and I've made some of the best connections and networks for life just purely from outreach, and it still shocks me to this day that it's so underutilized. I suppose. But
what I mean by LinkedIn outreach is actual outreach, not just adding them on LinkedIn and not saying anything. Exactly. Which you see a frightening amount of.
Not just adding a note like, "Hey, great to connect," or just a basic like actually adding value in a way before you seek value and sort of. Yeah. Developing a long-term relationship. I suppose something I want to really ask you is, and Naval Ravikant talks about this, the importance of learn to build, learn to sell. And in this, Iman's laughing because we mention this every episode, but I suppose they're both crucial skills, and you've mentioned both of them. If you were to pick one, or if you were to advise founders, if they're in their 20s or whatever, just regardless of age, which skill would you say is more valuable in the long run, building or selling, if they could only pick one?
In the long run, selling, probably. If you could just pick one, because the reality is if you're an early stage founder, you can know how, when I say build, I mean like tech development, actually knowing how to code and building the first kind of MVP of a product. Because really, a lot of founders, they only need to know how to build that minimum viable product. Then if they can sell that to investors, to clients, etc., then they're able to kind of get in some people who kind of know what they're doing and can put in a more scalable architecture, put in a proper product roadmap, and kind of deliver your vision. So I say sell because, again, you can build tech, but that's not really going to attract the talent that you need, just like, because you need to convince them that your mission is worth them joining, that they've got growth opportunities, etc., etc. You need to convince the best people possible to get on board. You need to convince the best investors to get on board. You need to convince your clients to choose you over an incumbent that is worth like billions of dollars, and they're never going to get fired for using IBM. Right, so no one's ever going to lose their job for you working with Microsoft. But so you need to convince, whether it's enterprises or users, to use you a company that is an early stage startup that hasn't really proven anything over anyone else. So that's why I always think selling, even though these are tech businesses, I think in the long run, you need to be able to sell, because everything is a sell at the end of the day.
And I mean, you can become a good engineer in, let's say, with 2 years of coding anyway. That's enough to really build an MVP.
Yeah.
There's so many tools out there now. But after that, in the long run, yes, I definitely agree.
Eventually, you're going to delegate that responsibility to someone who is an absolute kind of expert in what they do. And that's not just tech, that's marketing, that's finance, that's everything. And your role typically becomes selling in many guises. So they're both equally important, but I would say at the early stage, I think most people who are salespeople very much envy founders who can build that minimum viable product or even go slightly beyond that. Because it's just hugely valuable. And it saves a hell of a lot of money as well. It's the difference between you having to raise capital with a pitch deck or having to raise capital once you've actually got something to show.
Andy, on that note, so if we're saying long run, learning to sell is maybe slightly more important, but of course both are very important. Who's your favorite entrepreneur? You know, it could be dead or alive, but who's your favorite entrepreneur? I want to test if they fall into that bucket.
Who's my favorite entrepreneur? Do you know what? There's many different ways of answering this question, because it depends it depends what you kind of value or what you respect in entrepreneurs. And there's so many so for example, like I really admire and it's the personal side of things, right? So I admire entrepreneurs like Bill Gates, who regardless of what they've built, first of all, he's built a business that has stood the test of time and has continuously evolved. The right people have been put in place to kind of take that business forward. But more importantly, it's kind of the fact that they remain human beings and not kind of like demigods once they pretty much like take over the world. So people like Bill Gates, but I also have I have this sort of fascination with entrepreneurs, or not just entrepreneurs, but anyone who comes from a completely different world and manages to kind of build themselves into much bigger than they were. So I'm thinking of people like a Jay-Z, like a Dr. Dre, they are musicians that from, way back come from nothing, really. They come from poverty in the States. They have built like huge following as a musician. They go down as like, best rappers of all time. But there's a lot of musicians that are highly rated and they've built big brands, but it's when you can take your experience, your brand, your savvy, and start applying it to various entrepreneurial ventures for him, whether it's sports, whether it's artist agencies or alcohol beverages or art, do you know what I mean? And making some really shrewd investments along the way as well. It's people who kind of go beyond their lane. I've always had this kind of fascination with, whether it's athletes or musicians or entrepreneurs going to do another thing. Like, that's what really impresses me, because it's like, you didn't have to, it takes a very like certain type of person who can come from, let's say, rap world or athletics and then go into a boardroom or go into venture where they are completely out of their comfort zone, but still just dominate that world. So there's two different ways of kind of answering that question. But for me, I don't really I imagine most people would base their answer on kind of like the problem they solved and they were very passionate about it. And the reason why I don't say that is because like, I think there are so many entrepreneurs that are solving like such critical problems. It's difficult for me to kind of single out one. So I look at more at the person and kind of how they conduct themselves, even when they become kind of wildly successful in various different entrepreneurial guises.
There's a really interesting thing that I think you've raised, and that's learning to sell is not just for any listeners, is not just the art of selling. It's about communication at the end of the day. And it's interesting you mention Jay-Z, one of the greatest rappers of all time. He's literally built his brand on the ability to communicate in a way that resonates with people across any background, which kind of explains his growth as an individual, his growth as a musician, but then again his growth as an entrepreneur outside of music. It all comes back to that ability to sell and communicate in a way that resonates with people.
No, it's a really good point, and I never actually kind of thought of it in that way. But you're right. It's at the end of the day, if you're a wordsmith, you're kind of you'll be a wordsmith in every facet of life, whether that's in the boardroom or in athletics or music or otherwise. So no, absolutely, it's bang on.
If I were to bet on, I agree with you. If I were to bet on one founder type, it would only be if I could only pick one, it would be immigrants or those who come from poverty or difficult upbringings, like your Dr. Dre's or your Jay-Z's or whatever. So one last thing I want to ask you on Outwards. I know your average entry ticket is £1 million GBP, that is for US listeners. And then your average follow-on ticket is £2 to £6 million. So which deals have you had follow-ons for where there's been markups?
I'm gonna slightly swerve this question, and the reason why is just because of I have this feel. I don't think big funding rounds are like cause for huge show off or celebration, because like I saw a LinkedIn post, and forgive me if I'm butchering this, and I also can't remember who said this, but celebrating listen, it's a milestone that you've reached, and it's a kind of it's a reflection of what you've done to date, and that people believe in what you're building in the future. That being said, I think the LinkedIn post was something like, you don't see Formula One drivers celebrating a pit stop. It was words to that effect. And I completely agree. I think it's a great milestone to reach, but you're really, really proud if the business exits eventually. And the fund is relatively young in the grand scheme of things. Hopefully we're not too far away with some of the portfolio, but yeah, I think, listen, some of the obviously more obvious success stories in our portfolio, things like Curve, there's going to be some pretty exciting news to come out of them. Primary Bid, going great guns with their fundraise. Bud, Monets, these companies have all done relatively large follow-on rounds, and then you've got other companies that are relatively early, in the investment cycle, but they're also doing some really exciting stuff with regards to product, and I'm sure have a bright future ahead. That being said, go back to the point of, I think the success stories are when you actually deliver what you set out to do in terms of investing in a business, going through the journey with them, seeing them to exit, making them, their team and their all employees incredibly wealthy in the process, and also in the process delivering a return to your investors. You raised the point before of 7 to 10 years. I don't think a VC fund can't be judged really until the kind of 7 to 10 year mark, because one can raise very large rounds and then not get the exit that they think they're going to get, and then on the inverse, one can not raise much money at all and then out of nowhere get bought out for 100 million. So it's difficult to say at this point.
See, this is why we brought you on. I think we need to make you a co-host with the most logical answer.
I'm happy to take up guest. I'm happy to take up guest spots.
It's in line with the brand, you see.
Yeah.
So I suppose before we wrap up, something I want to ask you is really just for founders who want to reach you or pitch you, because you guys are not pre-seed or seed. If you can sort of outline what stage they need to be at, or what sort of metrics you'd look for, or whether it's intangibles, qualitative, quantitative, specific unit economics or whatever, what stage they need to be at, what sort of high level things that you already said what you kind of look for at the start, and how they can sort of pitch you or reach you.
Yeah, I mean, again, with early stage, you don't want to get too kind of rigid or prescriptive with the metrics. It's ultimately, we look at, and the same with things like revenue. I'm not going to give an MRR figure or a unit economic figure or anything like that. But really, I think the litmus test is you've got a product. You have some kind of client traction. If you're selling to businesses, it's like, and again, it depends whether you're enterprise software or kind of lower touch SaaS. You've got some evidence. There's some evidence of product market fit there. So whether that's kind of positive responses and usage from clients, whether that is a core team that you've got in place, or just for us, really, for us, the biggest focus we look at is, team, market, and obviously the problem that's being solved. And in terms of stage, I don't think it's ever necessarily too early to get in touch with us. I personally always like to see businesses when they are much earlier than we typically invest. And the reason for that is because you actually get to, get to know the founder over an extended period of time and begin to build a relationship with him and try and help them out along the way pre-investment. But more importantly, it's like you get to see the first pitch deck like a year ago, and then you get to see the pitch deck kind of when they actually come to invest, and you see kind of how they've managed to navigate through challenges they've had, whether that's a tiny little pivot or whether you get to see the traction increase or maybe not get to where it needs to be, and then they can actually kind of talk you through the real learning. Because if you see businesses just when they're appropriate for you, you just see a snapshot view, and you can get a historic view, but it's not, they can basically tell you whatever they want in terms of the story. But when you see them over a long period of time, you actually know how they've developed, so they can you can try and get them to kind of talk you through what were the challenges, what did they change, how has their mindset evolved, and what's the vision now. So I don't think you're ever too early to kind of reach out to us to kind of have the conversation and start building the relationship. At the point when we are going to invest, I would say the more prescriptive thing is if you're looking to raise between £1 and £5 million and you're looking for a kind of a lead, co-lead, follow investor, depending on kind of like what size of round you're raising, reach out to us. We never shy away from having a kind of a 30-minute, 30-minute to an hour call with a founder who we think is interesting. They're working on solving a very clear and specific problem, and they have a big vision for where they want the business to go. So where they can reach us, can reach me. Is my kind of email, or I don't know how you guys do, is my email going to be anywhere in the thing? If not, Andi.Kazeroonian@outwardvc.com. Drop me an email, add me on LinkedIn. Go on our website, outwardvc.com. It's got more information on the fund. You can reach out to any of us through there. I think there's a team email on there as well, where if you send us your pitch deck and a bit of information on you, it'll come to all of us. But I say the best way to reach out is always directly. Try and build the relationship with one of the members of the team. And largely people are always happy to kind of give up some time, the young budding entrepreneurs.
Are you, to wrap up, are you bullish long term? Are you long European tech?
I am. Yeah, I am bullish on European tech. And I think, listen, the US, I think the comparisons with US are like, they're quite unfair, right? It's a huge kind of single market. Yes, it's state to state, but there's, and it's just more advanced at the end of the day. The VC ecosystem has kind of existed there for longer. There's more capital. It's a bit more mature. As you said, even the kind of before you get to the capital, the universities, I think they foster entrepreneurship a bit more than European universities do. That being said, you are seeing the next generation of kind of like unicorns, decacorns. Again, I hate using those labels, but companies that are making a very, very material difference to society as a whole come out of Europe, and a lot of them in the FinTech space as well. I think actually of all the issues that Brexit has kind of caused, I think one of the things that, and I mean, this is completely just opinion based, I think it will become more and more apparent that, so have you noticed a lot of unicorns that tend to come out of like continental Europe, like Sweden or random locations outside of the UK, that tiny markets domestically. In order for them to kind of build significant businesses, they have to build global businesses, right? Because they know their local market in the Nordics or continental Europe is just not big enough. So they have to build a business with a global mindset. I feel like UK, and this doesn't just apply to entrepreneurialism, I think there's this view that UK is bigger than it actually is in terms of the market, the number of people, and all the rest of it. So I'm hoping that whether it's Brexit or just kind of the future, we get a bit more of that mindset of kind of understanding that actually the UK is not the be all and end all. It's not what you should be aiming for. You should be building a business with kind of global ambitions in mind, if that's the type of business you're wanting to build. I also say to people, and Rich coming from someone in VC, not every business has to be a unicorn. Not every business has to be, a venture capital backed business. There are plenty of businesses out there that they can scrap, they can grow organically, they can raise very little capital, they can sell for, handful of millions or whatever, but they still own 100% of the business, and they can make the founder can do really well for themselves. So that's a long way of saying I am bullish in Europe. I think there's more and more capital coming into space, and that's very, very important. There's different forms of capital coming at play. You've got CVCs, family office, VCs, all kind of vying for the same. Paul, you're seeing, as much as I've criticized universities, I think they are trying to do more to foster entrepreneurships. I think there's more happening outside of universities to try and foster entrepreneurship. And I think we've got one of the most kind of friendly regulatory environments and kind of tax schemes to promote entrepreneurialism. So yeah, I'm long European tech. Otherwise, I probably wouldn't be doing this. I'd have to look for another job. So yeah, I'm optimistic.
Well, there you have it. Extremely impressive portfolio, extremely rational, logical. Couldn't really ask for more.
Well, it's absolutely flown by, guys. Honestly.
Thank you for coming on, Andy. Thank you for coming on.
No worries. Pleasure. Thanks for having me. And yeah, anytime you want me back on board, happy to jump on.
We're gonna create a new segment called the Andy Take.
I was hoping for some very controversial parts from Cyrus. I'm gonna have to read an article later to see if he was holding back a bit.
Cyrus never holds back. So
there you have it. Cool. Andy, really appreciate you